Well, hello there and welcome everyone to the Advisor's Edge podcast. I'm your host, Rob Jacomen, and I am super excited to be joined by my co-host, Chad Ramberg, the one and the only. Chad, I'm feeling a little edgy today, so much so I actually have this new attire on, and I know you're really impressed with it, so welcome
Always
to the
impressed
show.
with you, Rob. Always impressed.
Well, we'll see about that after the show. But listen, we have a really exciting guest that we brought on today, and we got a really hot topic to discuss. And we have Greg Severinghaus from Markel. Greg, welcome to our show. Do me a favor, before we launch into learning more about you and all that other good stuff that we're going to dive into today, tell us a little bit about yourself. Tell us what you do and the problems that you help to solve for insureds, but also the agents that you work with.
Yeah. Thanks, Rob, and thanks, Chad, for having me. So I work for Markel. I'm an underwriting manager for a team of underwriters that insure financial institutions. I fell into insurance like a lot of people in the insurance industry, where you don't really go to school for insurance, but somehow you end up there. Actually, my first love is really economics and financial services. I worked prior to coming over to the insurance industry. I worked for a large mutual fund company, American Funds. I was also a registered rep and an advisor for a broker dealer. So I had that background as well. And just like we all do in this world, we network and your careers go this way and that. And I was introduced to somebody in the insurance industry. There was talk that, like your background, you could help us in this product line where we insure asset management firms and advisors. And I talked to him and ended up being recruited to come be an underwriter. I was with Markel for about 10 years, underwriting asset management firms with a focus on state and SEC registered advisors. I got involved with the marketing for my group. I led the marketing efforts and ended up, for many years, I would run around to industry conferences for Charles Schwab, TD Ameritrade, Pershing. You have industry groups like NAPFA or the FPA. I was pretty present at those groups, talking to advisors, working with insurance brokers in the industry, getting to know these folks. A lot of others that I've probably forgotten. Insiders Forum, Bob Veery's group, some others. I've probably forgotten them. But yeah, so I've really not only learned a lot about how we think about insuring advisors, but I've got to hear from them, and I have a background there, but also getting to learn from our end consumers. So that's been great. I did leave for a couple of years, went to work with another extremely strong insurance carrier in the space, the Hartford Financial Group, and worked in their financial institutions team out of New York. That gave me another lens into the financial institutions vertical. Not only do you have asset management firms, but you have banks and insurance companies and publicly traded REITs and sophisticated insurance towers with $400 million covering a mutual fund group. That was really good experience to round out my experience in financial institutions. Markel recruited me back a little less than a year ago to come manage another underwriting team. And so here I am today. And one of the keys to insurance carriers is we work through insurance brokers. So my clients are insurance brokers. I've known Chad for many years, and I've been glad to partner up with him again. I never stopped working with him, just I'm working with him again in a closer capacity. So
This is one of the great things about Greg. We've known each other well over a decade. He's always been smart, carried all of the things that he's learned over the years right into today. And so I'm so thankful to have you here, Greg. It's exciting to be able to give a little insight into what that looks like for our clients. And this is so cool.
Hey, by the way, the funniest thing is, Chad, how often have we interviewed folks in the insurance industry, or you've talked to somebody in the insurance industry and say, I fell into this?
Yeah. Oh, yeah.
I think we all fit into that mold of, this wasn't necessarily my career choice or what I thought I would be doing, but man, it's actually pretty cool. And here I am.
It wasn't the plan. Sometimes the best results are from things unplanned. So
Yeah, it's 100%.
yeah, so you've held all these different positions, Greg, in the insurance world. You've been an investment advisor. It helps us when we're communicating and trying to figure out something unique with an advisor. And I'm just curious, when you look at that experience you've had, what's some of the most interesting aspects of the work that you've done?
Yeah, good question. I think where I would lean on this, besides a lot stays the same, but some of the stuff that I find very interesting, especially within the last 4 or 5 years, is with the SEC. They've been a lot more aggressive. Our claims folks say since Biden came into office, there's some new emphasis on protecting consumers, especially in areas of advertising performance, anything leveraged, alternative investments. I've personally seen the fines and penalties. They used to be, if you've been an advisor for a while, you've probably been audited, state or a lot of the stuff, and I've read thousands of audits, but it used to be slaps on the wrists and fix this and move on. Now they're starting to try and make some points, and they'll hand out some stronger fees and penalties that I've seen. So that's been a little more aggressive there. The other thing I've heard from the claims folks is the quote was, the plaintiff's bar is amazingly organized and aggressive. Mm-hmm. And what they're doing is a lot of times, especially in that unregistered security space, if something fails, if something goes insolvent, they're all over that. They find out who's invested in it. They blanket the country trying to figure out who's lost money in these things. So you see these non-traded REITs a lot in the news where there's been some trouble. That turns into aggressive claims. And I'll tell you one thing that's never changed is you don't have to do anything wrong to get sued. Like you can be that, somebody told me that years ago, and I thought that was such a good line. Because you really aren't, really what I see when claims come in, somebody lost money and they want to go after somebody because they think they've been wronged. Or, and not only that, especially if maybe you made money, but you see the claims that come in, we're saying, hey, if I was in this other investment, I would have made 10x. So yeah, you made me money, but I don't think you put me in the right stuff. So you see, those things are the same. But yeah, so that's a lot of that's a couple points I would point to.
Yeah, that's great. Really, the thing is, it's so much easier when you're playing Monday night quarterback, looking at any situation, much less in a claim where the advisors, what my experience is, most of them are doing the right things. They're putting their client first. They're making the best decision for the client with the information they have, which is all great. One of the things we're going to do today is I'm going to ask some questions here that I get asked a lot from the advisors and the financial firms we work with, because I think they're going to want to hear that. So one of those questions, and a little birdie told me that you were on a working group with Schwab when they were deciding, are they going to custodials start requiring the coverage? Insurance carriers, if you're a life health agent, they've required coverage for a really long time. So it's not new in the industry, if you will, but the decisions for custodials to start requiring is new. So I get that question all of the time. I have my own thoughts on why that could be, which I share with clients, but I would love to hear from you, Greg, because you were closer to that decision than any of us were. Why do you think why do you think custodial firms have started requiring coverage?
Yeah, that has been one of the big changes in the last, I think, was it 3 or 4 years ago that came about. Schwab reached out to me. I think they just called me out of the blue one day. They found me through probably the conference I went to. I spoke a few times at some conferences and whatnot, and they collected a few folks that they felt had some insight into the industry. Obviously, Schwab's the 1,000-pound gorilla out there for the custodians. right? I honestly think what triggered this was all the social engineering claims that were coming in it spiked 4 or 5 years ago. Basically, social engineering is meaning an advisory firm or wealth management firm was tricked into sending money somewhere it wasn't supposed to go, right? So that's basically what social engineering is. And some of those claims would cross the Schwab desk, and the Schwab would say, we didn't do anything wrong. It was the advisor. And what happens when there's no insurance in place, there's nobody helping defend these guys. Through those processes and those claims, I think that came through, Schwab's like, wait a sec, why do people not have insurance? This is ridiculous. And then it got more thinking like, what about other stuff? And I don't know exactly what happened behind the executive walls of Schwab, but the working group I was part of says they didn't even quite know, but they've been tasked to ask questions about insurance, and they're likely going to start requiring their armada. And this was right around, like, they were about to acquire TD Ameritrade. So that, like, between Schwab and TD, that's, thousands and thousands of advisors. But I think if you get a firm to be insured, there's some basic underwriting. So I think Schwab probably liked the idea that a firm has to go through some underwriting. So there's another check there. They do their own checks and balances, whether they'll let somebody custody with them. But I think there was a little bit of that, and it just made sense. And they had so much weight and so much pull in the industry, they could just force the issue, so to speak. And then they did it. It was probably controversial at the time, but then Fidelity and Pershing followed, and here we are today.
Sorry, go ahead, Rob.
No, I was going to have a follow-up to that. I was going to ask Greg, what's the underlying thing that we all need to know or learn about what's actually driving those decisions? Is it more about the reputation? Is it more about just better protecting the client? Where is their primary mission and objective in making those requirements?
Yeah, from Schwab's perspective, obviously they're insured. Schwab's insured. Mm-hmm. If they have an advisor that's not insured, who's the plaintiff's attorney going to go after? They're going after Schwab.
That's a good point.
So I think really one was to protect them from lawsuits that it wasn't their doing. Usually, and again, I really think this started from the social engineering, but there's probably other instances that they saw over time. Maybe somebody had a large trade error, and trade errors can get pretty large. So you can get 7-figure trade errors. And if you have an advisor that can't cover that trade error, they go to Schwab, right? And Schwab's like, why am I paying this? You made the mistake. So I really think it was a rational decision by Schwab to saying, hey, we need you guys to be insured if you have problems.
Yeah, like a carrier, you see a large group of numbers, so they're automatically seeing that large law of numbers in effect at the time, mm-hmm. which is a different perspective than most of us. And obviously, they're going to want to, I would think, they're going to want to protect and keep their client base, which all custodials are going to want to hang on to the advisory clients that they're having help serve the end user. So what I'm hearing from you is all kinds of dynamics that go into it, but a few key ones that help illuminate it for our clients, hopefully.
And I think there was always a hold harmless there. Like the custodians always had a hold harmless saying, hey, if it's your mistake, like we're not helping you with that. But again, if you have an uninsured person and then you have a big insured entity, who are people going to go after with the lawsuits?
Of course. Yeah. It happened the same. It's just a transfer of risk philosophy. We had the same situation. I came from the contractor world. When you talk about subcontract agreements and the transfer of risk and making sure that there's an added layer of protection in there for each in that stream, each of those that are connected in that relationship.
In life insurance carriers, I think, Chad, you said it, life insurance carriers require agents that sell their products to carry a minimum amount of coverage. And that's been as long as I can remember. Before I even got in the industry, that's always been the case.
Specifically, sorry, go ahead.
I was just saying, I think it wasn't an illogical decision by Schwab.
Yeah. You mentioned specifically social engineering, and that's one of those key coverages that clients understanding. But for you, when you're looking at, because you see such a great perspective with both the claim side and the underwriting of that, when we're looking at different coverage types that financial institutions are transferring some risk on, what do you see as those types of risks that they really ought to think deeply about? Because of course the requirements, we're going to hit the requirements, but maybe there's some coverages that are more important today for the typical financial firm.
Okay, so right off the top of my head, by far the most common claim we get is a cost of corrections claim. It's an execution error. It's you put in the wrong ticker. You didn't understand the direction from your client. We had an iPad during COVID. We had a situation where an advisor was helping their client make a trade through an iPad, and they fumbled it up. So cost of corrections is definitely the most common claim we'll see. I think I said they can get, most of them are a frequency, not a severity. That's how we talk in the insurance world. But we do have 7-figure trade error claims and we have large accounts, concentrated positions, making a mistake. So certainly that's one area. It's insurance brokers that know what they're doing in this space, make sure their clients get that coverage in the policy because it's not always in there. We're talking about things that create claims, unregistered securities. There's somebody told this to me for investments. Is it publicly traded? Is it liquid? Is it transparent? And if you can answer those three questions, it's easy to defend you as an advisor. Again, you don't have to do anything wrong to get sued, but if you do, we're going to defend you as a carrier. And so unregistered securities don't meet those criteria. They're hard to get out of. They're a little opaque. When you're not publicly traded, you're not typically regulated. So the thing that will happen is a plaintiff's attorney will say, was there a publicly traded alternative to this security that you could have recommended to your client? And you have to have an absolutely fantastic answer to that, or it's going to be hard to defend you.
That's a nugget right there. You know?
And so to that, and finish up, I was just going to say, so that would be another thing. Some policies don't cover unregistered securities. So if you do a lot of that stuff, you need to make sure you have a coverage for that.
Yeah,
go ahead.
What it sounds like is that's also why we typically see a higher retention or a deductible and higher premiums for that, because it starts to get very nuanced when it comes to the defense side of it. Am I hearing that right?
Yeah, absolutely.
So I have, can we dive deeper into something Greg said? Because I think this is something we really need to uncover even more.
Yeah.
Because it really struck, this is really what I still have this mind ninja going off in my head. It was like when you're talking about, this is really important, I think, for advisors to know. Greg, when you're talking about, you don't necessarily have to do anything wrong to get sued. That's a really big deal. And it's something to think about from the standpoint of protecting yourself from those kinds of situations and the importance of insurance. Because I think I've been in this industry almost 20 years now. And I think people just gloss over insurance as, that's just the cost of doing business.
Yeah.
When no, that's not the way, you really don't want to look at it that way. The way you want to look at it is like, how can you put your best foot forward, execute on best practices inside of your business, and protect yourself from situations where, sure, maybe you didn't do anything wrong, but it's a very litigious society out there right now, and people are just looking for opportunities.
Yeah.
And they're looking for those opportunities where you didn't even think you did anything wrong. So I'd love for you to uncover what are some best practices that advisors can execute and implement that could potentially shield them or better protect them in a proactive way from these kinds of situations happening in the first place.
I love this question. I get questions all the time. Can you cover this? It'll be something in an investment firm that may be a little different. And my first question is, what does your client agreement say you're doing for the client? And if there's no explanation in the client agreement about what this is, why you do it or why you do not do it, I think that opens up opportunities for claims. So I think paying attention to your client agreements, which say what you are doing for a client and also what you're not doing for a client, is extremely important, whether you carry insurance or not. And by the way, that's always been, there's been so many advisors I've talked to over the year that question whether they needed insurance, because it goes to this point. They're like, I don't see, I'm not doing anything out of the ordinary. I'm doing traditional investments. I'm just doing basic financial planning. And I have the vanilla practice. I run a vanilla practice has been something I don't need. The thing is, it goes back to something I said earlier. If you get claims when people lose money or think they lost upside of something that they should have had. And that's all it is. If all of a sudden you don't have as much money as you thought, that becomes very personal for you. And no matter, I don't care if you're executive at a Fortune 500 company or a widow that doesn't know anything about this stuff. Like, it's personal when you lose a lot of money. So paying attention to that. I think another one I just wanted to, there's a lot of these little things I could throw out, but one I wanted to mention was over disclosing your conflicts of interest. So you see this a lot when you have a wealth management firm that's doing a couple other things. Maybe they're selling life insurance, or maybe they have a proprietary private fund that SEC's all over this. If they come and audit you, they want you to disclose your conflicts of interest. But I say over disclose it. If there's any way a client can say you weren't completely clear about that, becomes a problem for you as an advisor. So the clear, and that goes for fees too, over disclosure fees. If you charge a fee and maybe a fund has another layer of fees, you got to over disclose that. I always say it doesn't matter how much you charge. As an underwriting company, we don't care what you charge, but are you disclosing it accurately is what we're very keen on seeing. So, and this would cover a lot, but the SEC, it mirrors a lot of the stuff we look for too. When you have an audit from the SEC or the state comes in, they're looking for the cyber stuff. You need to know where your PII is and your cyber procedures. You can't say I'm working on them. This is long ago. You need to have them in place and they have to be good. So,
well, what I'm hearing kind of two themes here. I'm hearing clarity and intentionality. So we want to make sure we have as much clarity as possible and be very intentional about the work we're doing and not doing. Is that kind of overly simplified from an insurance broker's perspective, but it's still important.
Yeah.
Great.
I agree. I have another question, follow up to that, Greg, if you don't mind.
Sure.
And I apologize. I know you have an agenda here. We can cut this out. I know that you have an agenda here, Chad, but this is really important. I think this is going to be a good one for content.
This is what we love at the back and forth. This is what makes it human and more interesting to listen to. So let's leave it in. Yeah.
Yeah. So that's true, actually. Makes it raw.
That's
Greg,
right.
Based on all the things that you just mentioned, because I really think it was amazing wisdom what you just shared, how important, because obviously my background, I'm all about industry niche specialization and making sure you're working with the best of the best. Mm-hmm. How important from your perspective, because you're on the carrier side, how important from your perspective is it for an advisor or broker dealer, anybody on that side, to be working with an industry niche specialist who specializes in this industry and knows all the nuances about these different things and knows how this system works? From an insurance agency standpoint, like a guy like Chad, how important from an underwriter's perspective is that for insureds to work truly with the best of the best, the experts, the ones who understand that industry inside and out?
I'm going to answer this question from some claims I've seen, the perspectives of some claims I've seen, because I think it sheds a little light on things we see that could have been prevented if they had the right policy in place, and that comes from having a good insurance broker finding the right fit for you. But so there's two examples. One that we've seen more frequently, where you have a claim comes in and the policy properly responds and you have full coverage for defense and damages. There's two parts to any claims, defense and damages. What sometimes happens is the defense and damages are more than the policy limit. Now, we've had a couple examples where, again, back to this, I don't think I'm going to do anything wrong. I don't need that much insurance. I just want to check the box kind of thing, right? There's that, right?
Yep.
And you bump into these limit issues. Sorry, your limit's out. We've used it all. Like you had great insurance in place, and many times I've talked to the brokers for these policies, and they're like, yeah, I have in my file that I recommended a higher limit for that client, and I have in my file that they declined my offer/recommendation. So we're seeing more of those, especially as just the costs have increased. Litigation has cost more, the damages, the market, just looking at the stock market, it's so much bigger than it used to be. So when it falls, you lose a lot more money. There's more money to lose. So more damages to pay out. Making sure, that's one example I've seen. But then there's also the uncovered claim. So we see this all the time where a claim comes in, and trust me when I say that most insurance carriers, they're not in the business of denying claims. They want to, if you call them with a claim, their goal is to find coverage for the litigation that came in. But if it's uncovered, it's not a covered peril, and we send a reservation of rights, and this is not covered kind of thing. And that gets dicey because sometimes the client says, oh, I thought I had coverage for that. You had a private fund, or you had a little bit of alternatives that it's specifically excluded in your policy. If you don't talk to an insurance broker's job is to help you work through those potential coverage things to match it up to your firm, because anybody that runs an advisory firm, they all look different, right? They all need different things. They all do different stuff. So I would say that matching up, having a broker review that knows what your business is about, knows various carriers in the industry and various insurance coverage forms, to look at them all together and find the best fit, I think is invaluable. We as a carrier can't do that for you. If you came to us directly, we have one form, one coverage. We don't know you that well. We can give you a piece of paper, but we don't know your firm. It's not our job to learn about you.
That's where that's where really good brokers come in handy. Sorry, Chad, to interrupt you. Is those brokers who, and this is where I came from a consultative perspective, is being proactive with risk management. A lot of these things can be proactively dealt with if you have a game plan and a strategy in place for your clients. So having a written game plan and says, hey, these are the things that you can do proactively to better manage risk. And these are best practices. Now, it's up to them if they're going to execute and implement, but as a trusted advisor, you're providing that added value to that relationship and building that trust. You're then in a position where they have a game plan, they have a strategy, if you help them implement that, you have a greater opportunity and chance to mitigate those types of risks and those types of situations from coming up in the first place. And it's exactly why I asked you those questions, like, hey, what are some best practices that insureds can implement to help be more proactive about how they manage these risks and exposures?
And there's so many different bells and whistles and coverage parts you can put on an insurance policy. I remember years ago, a potential policy holder literally said, what does this cover? Like if a client's sitting in my office on a chair and the leg of the chair breaks and he injures his arm, Is that covered by, and that's a really far out there example, but that obviously that's not what this insurance is for, right? This is a professional liability contract. So you talk through that, but then you can add employment practices liability. There's theft coverage. What if somebody inside your office steals from you? These are all things that you can add on to an insurance contract. And if you don't want them, that's fine. You're self-insuring that risk, but we do see these things where it's a tough position as a carrier. We hate to have to do that. If you submit a claim to us and it's in an area that it's not covered, like that's not we don't want that. That's not good for anybody's reputation. Insurance brokers, we are partners with the insurance brokerage community to help us do that and match things up to have the best fit for clients.
Yeah, you've given a lot of different cases as to why a good broker is helpful to have. So I appreciate hearing that from the carrier's perspective, because clients a lot of times are like, I'll just go direct and get it. And it's just in this space, it's not how it works. So I think I got a lot better understanding of why that is from a carrier's perspective. Go ahead. Yeah.
And I'll tell you, like, I hear the same thing. Like, people would say, I'll just go direct and I'll go get a piece of paper, because it's a check the box kind of things. And honestly, some advisors can go 20 years and never have an issue. And it happens, right?
Yeah. No, I got to tell you this one story. Yeah. It's so funny. It's funny, but it's not. Really good advisor, salt of the earth sort of guy. And when we were setting up the policy, he says, look, I've been doing this for 30 years, never had a claim, never going to have a claim. I'm going to take in this case, plain vanilla, really high deductible for him. He says, I'm going to take a $50,000 deductible. And I said, that's fine. My job is to give you options. And we had coverage with him for a couple of years. And he calls me up one day and he says, Chad, the unexpected happened. And he had a trade error claim. And I just felt for the guy. But he was such a good guy. I said, hey, do you remember when we talked about this originally and you told me you want that higher deductible to save, I don't know, $1,000 a year? And he said, yes.
Yeah.
I mean, it's just life, right?
Yeah.
We don't expect it to happen if it never has.
Yeah. And this is just to my memory, this brings up a trend we're seeing a little bit more of.
Yeah.
As an advisor, a lot of times you are extremely close with your clients and you're like, I am so comfortable. These are like family for me. And I completely get that thought process, and you feel some safety there. And you're like, okay, I mean, you feel insulated. Where we're starting to get some claims more, and I'm sure you guys have seen them too, but the main account holder dies. And the inheritant, the people that are inheriting get involved. And all of a sudden they come in and may have a problem with something and they think it was mismanaged or whatnot. And that's starting to get a little hairy. And so I folks that have been to conferences and speakers on this topic, you'll hear them say, get to know the families, get to know the children, the people that are going to inherit the assets. Those claims are definitely hitting now.
Yeah.
They're starting to come in.
A great pivot point. And you're right. We're hearing that. I think I've got 3 of them right now in the hopper. and let's face it, insurance is an expense until you need it. Yep. And so what I want to ask from a carrier's perspective, because it's painful for me to tell any company owner that, hey, we have this expense. This is a smart thing to do. The smart ones understand that. Okay. But there's also growth and development and the focus on future growth for their firm, because that's what's going to keep them healthy. And so to that point, I've told clients before, knowing the next generation is not only a good risk protection best practice, but it's also an opportunity to actually grow the assets of the firm that you're managing. I am sure there's some other areas that when we look at insurance, it is about protection. That's the core of it. But what are some other ways to look at it that actually helps the businesses develop and grow to that next stage?
Yeah, I can give you my perspective from the risk management side, because what I've seen over my career here is you have small wealth management firm, small advisors that maybe had a couple $1 million have managed to start. They've grown, done extremely well in hundreds of millions, and even grown into $1 billion firms. Yeah, they literally grow, scale. And I think and then there's mergers and acquisitions. You might sell your practice or acquire practices. From our perspective, we always want to know how when you're scaling, how are you keeping policies and procedures, your investment philosophies, and how you're doing business consistent, especially if you have multiple offices, et cetera, because you may be running a tight ship in Arizona, but then you have a couple people up in Michigan. No, I didn't mean to call out Michigan, but who are doing their own thing. How are you scaling and keeping people working in the same way that around the corporate principles you've established? So that's something we see a lot, and we're seeing a lot more of these. We call them like network RAs or roll-up RAs. They're the RAs that are building out, and similar. We do insure some broker dealers as well. In fact, that's a space that ever since was it Regulation BI, best interest, 5-6 years, whenever that was. There's more of a fiduciary responsibility, not quite as strong as the fiduciary, but it's still something where I felt like broker dealers are looking a lot more like RIAs now. And the risk perils and the claims have gone down on the broker dealer side. But those are examples of these firms that some have scaled pretty well, and they're multi-state and similar thought process. What's your hiring process? How are you keeping these guys on track with the principles of the firm? Not out there just selling a product, but actually trying to meet a customer need and do that. So I don't know if that was exactly the answer, but that's from our risk perspective, what we see and look at.
Sure. Going through what I hear you digging into there is going through that application and answering the questions and thinking carefully about them is going to help that firm actually build better for the future.
Yeah, absolutely.
Yeah. Or which is that next stage of growth, whatever that's going to look like.
I've always defended longer applications. I know there's this big thing. This is a totally different topic, but brokers and policyholders, the insurance application process feels like people get annoyed by it, the lengthiness of the process and these questions. I actually think from a carrier's perspective, the more we understand what you do, the better terms you get from us, because we don't like to be uncomfortable. We like to know what's going on. If we get any feel that something's being hidden from us, that lowers what we want to offer you, increases our premium, so to speak.
So we're wanting to add that clarity in there for sure.
But the questions are asked because you learn stuff about what the practice does, and maybe there's something you need coverage for that you would not have in a normal contract. And between the carrier and the insurance broker, we can maybe address it. So
yeah,
that is gold. I don't want us to stop right there, because what you just said was gold. For any insurance agents or brokers who are listening to that right now, you're hearing it directly from an underwriter. You don't hide stuff.
Right.
You share as much as you can, not for the purpose of, something bad's gonna happen and they're gonna decline this or whatever. No. What Greg is saying is, the more they understand your business and your operations, the more favorable it's going to be for you, and you can communicate that to the client. You can say, listen, we really need to get as much data and information as we can so we can better assess and learn about your operations and all the nuances about your business, so that we can design the best contract for you possible and give you the most favorable terms and rates.
Yeah.
So it's not going to necessarily going to hurt you. It's actually to your benefit to get all that information.
Yeah. Said.
And 9 times out of 10, if you go through with a client, and this happens so many times, I can't even count it. I'll send a note to Greg and say, hey, Greg, we got this unique situation. Can we enhance the policy, and what additional premium are we talking about? Just by asking the question, and Greg comes back and says, yeah, we can do this adjustment. Here's what it would look like. And it's an additional $500. 9 times out of 10, the client's gonna say, $500? Absolutely. Okay, let's do it. If it was never asked, it's in the unlikely event it happens, that would be really expensive for the advisory firm. And I'm surprised continually how sometimes these seemingly simple things have a quite economical, good cost benefit to them. Yeah. No, this is great.
Could be here all day, right?
We could be here all day. And,
we gotta wrap it up. We gotta wrap it up, though. I'm sorry, Greg. We don't want to keep you too much longer here, but we gotta land the plane eventually, right?
Yeah. Maybe we'll have to have you in again sometime, Greg. We do like to keep this a little bit personal and understand you rather than just all the technical talk here. Would love to hear a little bit when you're thinking back on the great work that you've been doing. What do you want to look at your life and say, this is what Greg Severinghaus is known for?
I'll answer that in two ways. At my stage in my career, I think I've gotten pretty good at like seeking out like just random coffees or lunches or grab a drink or, hey, you want to go jog a couple miles with me and just catch up with folks? Not because I want anything, but just to catch up with somebody, get to know their background, maybe learn a little something, keep my network. I wish I'd done that my whole life. When you're right out of college, maybe you're just not thinking about that, or maybe you think you're annoying more senior folks and you're like, yeah, they don't want to talk to a young guy like me. But I wish I'd done so much more of that. I think I'm a natural coach. Like I like to be a sounding board. I don't always have the right answers, but I like to be approachable and non-judgmental. I like people seek me out. Chad, I think 5-6 years ago, you reached out to me and just wanted to bounce off something with me. And I love that. I love when people do that. So I'm going to spend the rest of my career encouraging people, if they want to talk about something, reach out, let's talk about it. Or if you just want to catch up, that's great too. I think that's what I'd like people to know about me.
That's great. Professionally, you've been an ace, Greg, and personally, I consider you one of my good friends, and I'm grateful for that. Thank you.
Oh, thanks for saying that. You as well. It's been nice knowing you all these years, and you've done a great job providing a lot of awesome service for your clients, and I hear it when every once in a while we have to talk to the clients and they talk about the insurance broker and where they met them. So I hear great stuff about you and your firm all the time too.
Thank you.
It's awesome. Greg, you were awesome today. Man, like the gold nuggets you dropped today were like, I call those value bombs. They were like value bombs. And
there's a half a dozen that are fantastic in there.
I don't even know where to start, but I'm extremely grateful to have met you and have learned about you, and you're just a first-class guy. We're extremely blessed to have you in this industry. Like, I don't think people realize how valuable you are as not only as a person, but professionally as well. How can people find out more about you, Greg? What do you have a LinkedIn profile, or what's the best way to reach you if someone was interested in connecting with you?
If you want to connect, I think LinkedIn is I think people have become very adept at figuring out Greg Severinghaus. I work at Markel currently, and I'm happy to, if you want to talk about anything, please reach out, connect with me on LinkedIn. Happy to, I love that. So
awesome.
Yeah.
Awesome. Guys, listen, that's a wrap today. We're extremely honored and blessed to have Greg on the show. And as always, we're always looking to bring first-class people who are truly good people, but also the best of the best in their field. And Greg certainly embodies all of that. Greg, thank you so much. And we're looking forward to having you on again at some point.
Great. I'd be glad to
jam on some nerdy stuff, but I love getting into the personal stuff and hearing your story. It's just been a real honor to have you on. Thank you so much.
Thank you. Thank you to both of you.
All right, guys, that's a wrap. We'll see you on the next episode of the Advisor's Edge podcast. Take care.
Yes, sir.